Hi, everyone, and welcome to our August edition of Markets in 2 Minutes. This is Darrell from the WealthSpire investment team. So, a lot has happened in the past couple of weeks in the marketplace, and after what was a relatively uneventful first several months of the year, we saw volatility come back with a vengeance in early August. In fact, if you look at the VIX index, which is an off-cited measure of market volatility, it spiked to its third highest level since it was developed over 30 years ago. But interestingly, the underlying source of all of that uncertainty was a little bit out of left field and an illustration of how finicky markets can be, especially during the summer months when trading volume is lower than might be typical. So, as the market downturn progressed, it became apparent that what was going on was being driven primarily by the unwinding of something called the yen carry trade. And essentially, the yen carry trade is a very popular trading strategy that many investors have had in place for over a decade. And it's a result of the fact that the Japanese central bank has kept local interest rates at essentially zero for a very long time as it's tried to stimulate growth in the Japanese economy. And the strategy really involves borrowing money at very low interest rates in Japan and then investing that money in other markets where expected returns are meaningfully higher. And generally, that means global stocks, including US stocks. And the chart here shows the long-term benefits of this type of strategy. The lighter shaded blue line is the return on the S&P 500 if the trade was funded by first borrowing capital in the Japanese market. And you can see that over the course of many years, this has been a very profitable strategy. But at the beginning of the month, the Bank of Japan surprised virtually everyone and decided to increase interest rates for the first time in almost 2 decades. And so investors started to consider that we might be entering a new era where this trading strategy may be less profitable. And so many traders started closing their positions out, and that involves selling stocks. So that sudden shift in behavior put a significant amount of selling pressure on markets around the world, which led to the sudden drop in prices that we all experienced. The good news is that this was largely a technically driven event, and so it was quite short-lived. And the other key development that we wanted to point out here, and this was lost in the shuffle a little bit with how chaotic things got for a few days, is that bonds came through for investors and offered true diversification benefits during the sell-off, which is something that we haven't seen them consistently do in recent years. And you can see in the charts here that equity markets over the course of that week were down a little over 5% when all was said and done, but losses were meaningfully larger in certain pockets of the market. Meanwhile, though, bonds produced a positive return and helped provide that safety net for investors. So from our perspective, this was a really positive development because we've been pushing back for quite a while now against the notion that the traditional 60/40 portfolio is dead. And we've been trying to get the message out that bonds still have an important place in portfolios. And the price action of the last couple of weeks, with bonds producing positive returns amid a big equity sell-off, really helps to solidify that message. So thanks again for listening in and hope to see you all next month for another update.